Stocks in the green across the board to kick off the week of trading. My next guest says there may be some downside risk ahead for the S&P along the long and winding road to 4,800, though he adds technical green shoots are starting to sprout. Let's bring in John Kolovos, Chief Technical Strategist at Macro Risk Advisors. John, it's good to see you. I assume if you think ultimately that it could be a long and winding road to 4,800, that's basically the old all-time highs. Question being, do we have to have some kind of a further pullback along the way? What's the current evidence suggesting to you?
Well, thanks, Mike, for having me on, and great to see you as well. What I'm seeing right now, like I said earlier, is that 4,800 is approximately where I think the S&P should get to by the end of the year. The primary technical green shoot that I'm seeing right now, besides trend just being positive, right, from a very simple standpoint, there's a series of higher highs and higher lows well in place since the October bottom. So trend is positive, right? But now we're finally oversold since the market peaked in July. We were going to get a pullback. It didn't matter if you were a bull or a bear. We got it. Now we're oversold with only 30% of the Russell 3000 above its 50-day moving average. And that should be oversold enough, assuming that we're still in a bull market.
Yeah, exactly. Assuming we're in a bull market, these are the kinds of conditions that are, pretty good entry points or places to buy the dip. I guess the question is, how do you make sure, or at least get the odds in your favor that it's still a bull market when you do see some kind of signals of late cycle conditions developing?
Right. So a couple of things. So yeah, so it's a mosaic, right? So if equities lived in a vacuum, I think it's a relatively easy call, to be quite frank with you. Seasonal weakness aside, that's quite normal. It's looking more at the macro that it makes things a little bit more challenging. The dollar's too strong, rates are too high, right? But what's interesting here, though, Mike, is that the volatility of that is well behaved. So yeah, dollar's going wrong way, rates are going wrong way, but they're not explosive moves yet.
That's a good reminder. Last year, the extreme bond market volatility was something that really the stock market could not really kind of come to terms with for most of the year. I know that you also have some work about what happens after the final Fed rate hike in a cycle. What does that mean for the current moment?
Right. So typically what happens after the Fed is done hiking rates, equity market has a tailwind for about 7 months or so, because on average, around 7 months after that final hike, that's when they start cutting, right? It's typically a tailwind. And if I do my math real simple, I think that gets us to about February of where the market should start to wobble a bit. But what's interesting is that if we look at data going back to 1929, where we include other inflationary regimes or higher interest rate regimes, there's only about a 2-month window, right, where the markets have a tailwind. And that's kind of right where we are right now. So when I go ahead and I look at where the dollar is and where rates are, and now this technical green shoot, I really do think that Wednesday is going to be a huge, huge catalyst for the market, not just for the rest of the quarter, but for the rest of the year. So basically, anything deeper of an oversold condition is going to start signaling to us that, hey, maybe we are just in a cyclical bull within a secular bear.
Okay, so maybe it can actually be a swing factor on Wednesday. Just quickly on the dollar, you mentioned it, kind of going in the wrong direction. Although it is pulling back, the U.S. dollar index pulling back today. Some, Asian countries trying to defend their currencies. How is that situated? Yeah,
so my call is this. Dollar peaked in late last year at 114. We're going to continue to push lower. Down to around the 95 area. So it's a longer term downtrend. But to be honest with you, from a technical perspective, the rally since July has been a little bit too strong for my comfort. But do note at the chart where it is. While it's a strong rate of change, the trend is still intact. So you really have to see it break above that 106 level to change the character of the dollar. So what would that mean, Mike? That would either mean that the dollar put in its low and it's going to make new all-time highs, or it just may mean that we just need to extend this rally to the 110 area. And the way I'm seeing things, and that would just perpetuate this decline in equities. 4,300 is an important support level that has to hold on this pullback. Otherwise, we're going to have to look at an even windier road to 4,800 with a test of the 200A. So this 4,300 area is key to hold over the next week or so.
Yeah, seems like a pretty delicate balance. It's just a few percent down to 4,300 from here. John, thanks very much. Good to catch up with you.